Okay, Chapter 5. This chapter is about job costing, and we're looking at various methods to determine the cost of manufacturing a product. So we've been just talking about manufacturing in general up until now, but when you're looking at job costing, there's process costing and there's job costing. But the end goal of both methods is to find out the total cost of manufacturing one unit of the product. So with process costing, that's used when you're making a large number of identical units. So you know, you're looking at, it's a continuous uniform process. So think about paint manufacturing, oil refineries, cereals, etc. So you can't you can't differentiate the cost of, you know, one barrel of oil versus another, or one bowl of cereal versus another, that type of thing. With job costing, these are unique custom products or small batches, so you can trace your cost to the particular job. So think about car repair shop, home builders, advertising agencies, etc. So remember how the inventory flows through the system. You have your raw materials, and then you move your materials into production, so it's work in process. Then you have your finished goods, your unsold products, and then as they're sold, then the costs wind up in your cost of goods sold on your income statement. So what we are going to do first is look at how to allocate the manufacturing costs to various jobs, because remember, you really can't directly trace it as such. So what we're going to do is come up with a predetermined overhead manufacturing rate. So at the beginning of the year, the company, based on its previous, like last year's cost, and based on estimates for this year's cost, they're going to come up with their total estimated manufacturing overhead cost. Then you're going to select a cost driver. So a cost driver can be driven by, for example, direct labor, direct material, etc. So if it's you know, a lot of manual work, then you're probably going to use direct labor as your allocation base. But when you're given a problem in this course, you'll be told you know, what the cost driver is, whether it's labor or materials or something else. So you want to take your total manufacturing overhead, divide that by the total amount of the allocation base. So this is going to give you what we call predetermined manufacturing overhead rate, or you can use POHR for short. So if you have your total estimated manufacturing overhead costs of $1 million, and you're expecting the total direct labor hours for the whole year to be 62,500 hours, you take your $1 million and you divide that by the 62,500, so that's going to give you $16 in overhead for every 1 hour of direct labor. So when you're trying to figure out how much overhead to assign to a job, so if you have job number 306, you're going to take your $16 overhead rate, you're going to multiply that by the number of direct labor hours. And so in this case, it's $184 you're assigning for overhead. So of course, when you're estimating overhead, when all of the bills come in, and by the end of the year, of course, you're going to know the exact amount of overhead, and you know, some of your estimates could be a little over or a little under. So you end up over allocating or under allocating manufacturing overhead. So at the end of the year, you have to adjust for that and dispose of it. So you can calculate the cost by tracing, the materials and direct labor to, each job, but it's the manufacturing overhead that needs to get allocated using that predetermined overhead rate. And as I mentioned, this does result in either not assigning enough overhead or assigning too much. So when you're looking at this, we looked at the actual manufacturing overhead here is $25,000. And we've allocated $24,000, and that was calculated. We had that $16 per direct labor hour, and for this certain job that we're working on, we work 1,500 hours. So 1,500 hours times $16 is $24,000. That's how much was allocated to the jobs. So you've actually under-allocated because your actual cost came in a little bit higher than you had estimated. So you got that $1,000. So basically under-allocated, your actual cost came in higher than you had predicted. And if you over-allocated, the actual costs are lower than predicted. So you either have not enough charge to the product or too much charge to the product. So if the overhead or the under or over allocated amount is not really large, it might be considered immaterial. So you would just look at that as a period cost. But if it is material, then you might want to look at spreading it out over the 3 inventory amounts. So if your manufacturing costs have been under-allocated, this means you've got to increase your cost of goods sold. So you've got to add the $1,000 to the cost of goods sold. Or if you've over-allocated, then you added too much cost to your product, so you got to decrease by $1,000. So when you're looking at your manufacturing overhead, the actual compared to the estimated, there's 2 ways. So the first one we just did, where we took our full $1,000 and we just either increased or decreased the cost of goods sold. But if there's a fairly significant variance, a company may well decide to prorate the difference, the under or over allocated amount, between the 3 inventory accounts. So between cost of goods sold, work in process, and finished goods. So those are your 3 inventory accounts. So it's important to really have good product costs, try to keep them as accurate as possible, because you're going to use that information to help maybe reduce future job costs, help you identify the profitability of the products, pricing decisions when you're bidding on contracts. When you're bidding on contracts or special custom orders, your historical cost information is very important. And of course, you need it for financial statement preparation. So job costing traditionally focused on assigning only production-related costs to jobs. Period costs are typically treated in the past as operating expenses, but managers need to know the total cost of the product across the entire value chain. So adding non-manufacturing costs to the inventoriable cost, that really helps build the total cost of the product. But now remember, this is used only for internal decision making. You're not going to use that for external financial reporting. So here you have the T account, so we have our manufacturing overhead allocated, and what we would want to do is either increase or decrease the 3 inventory accounts by the under or over allocated overhead amount. So job costing, we've just talked about job costing in terms of production of various goods. However, you can also use job costing in a service firm as a basis for billing clients. And think about an accounting firm, a law firm. They all keep track of their jobs, all the cost that are incurred, and they bill it out to each particular job. So you want to make sure that you're really addressing the full cost of the service that you're providing. So, it's easy enough, of course, to allocate if you're a service firm, your labor, because you're supposed to be keeping timesheets and keep track of the hours you're spending on each client. But we also want to make sure that each job that you are working on actually reflects its share of indirect period costs. So there's no inventory here, but you do need to keep track of these costs, because you want to make sure when you quote it in the future, you're calculating all of the costs to deliver that particular service. So you have the direct costs of serving the client, and then you have your indirect costs. So your direct costs would be your labor, and then the indirect costs would be some of those overhead type of expenses that you need to run your business. So that concludes Chapter 5, and as usual, I've got detailed demonstration problems and the YouTube video to show how to solve them, and do your quick checks, and the end of chapter summary problems in the syllabus. So that concludes Chapter 5.